In the recent years, we have seen the rise in the technologies like machine learning and AI. Do you ever wonder what this technology will do in the field of finance? Can there be machines who can trade on stock markets and help us make money? Isn't it interesting? Let's learn and understand more interesting insights about the same from our today's speaker. Our today's speaker is a CEO and co-founder at company AAA Quants, Australia. After his PhD in physics, he co-founded a microchip design company, PCME. He then followed a call from Oxford University for a senior research fellow position for computational modeling of nanomaterials. Subsequently, he worked for companies like Rolls-Royce, Memjet Australia, Valor Private Wealth, ComLife in different capacities to develop automated system and quantitative financial models. He has published 20 plus scientific papers with hundreds of citations and 3 patents. Please put your hands together to welcome our today's speaker, Dr. Thomas Starke. Prashant, MD of Ideas Revenue Solution, to present a small token of appreciation to Dr. Thomas.
Hello, everyone. Hi. Thank you. Oh, wow. Thank you so much. Wow, wonderful. I just passed that on. Thank you. Sure. Thank you. Well, wow. Thank you all for coming. I hope everyone can hear me okay. Just one sec. Just go try to switch this on again. Can you hear me okay? Yeah? Okay, brilliant. Can you see this? Yeah. Might be a bit difficult. But, okay, so it's a real pleasure to be here. This is my last talk in India. I've been to pretty much all the big cities now. Mumbai, Bangalore, Delhi and Pune now, and done a lot of talks, ran a lot of workshops, and I'm really enjoying this. And I have to say I had really the best audience here in India that I've ever had. And I was actually giving a talk in Pune on Monday about machine learning and reinforcement learning for finance applications and trading. And today I just wanted not to repeat the same talk again. So for those people who came on Monday as well, this doesn't really work. It comes and goes, right? Is it okay? Okay. So I wanted to basically just say or give a slightly different talk. And so today I talk a little bit more about the ins and outs of reinforcement learning in trading, which we've done quite the research on. And for any of you who have a question intermittently, please just feel free to ask. I'm more than happy to answer that straight away. So this talk was actually originally given this year in April in New York. So that's why it still says QuantCon New York here. I gave that on Wall Street. And so it was really well received. And if anyone wants the slides, they're on SlideShare, and all the code that I might show today is also available on GitHub and so on. So just one more word. This whole trip around India was sponsored by a company called Quantopian, and they basically provide really amazing platform to get into quantitative trading. They also provide sort of the systems and the back end to get market data. They have a lot of lectures, you can learn a lot. And it's a really interesting thing, and the workshops that I've been running were loosely or more directly actually based on their platform and basically helping people to get into quantitative trading. So I just wanted to start with see what my audience is, because what I do a lot is ask who's actually on my audience, because quantitative trading is quite a multidisciplinary subject, and I always get a large variety of people. Sometimes they're all finance people, like what York. Sometimes most people are just from the tech background. And just today I wanted to know who's actually from an AI machine learning background. So there's quite a few. Who's generally from a IT tech background, maybe not machine learning. Pretty much everyone else. Who's from a finance background? Just a few of you. Okay. So what I'm probably going to do today is then move a bit more into the finance side of things as well, because that's probably something that you haven't heard so much about. One of the things that I find always is there's a lot of people that move into this field of quantitative finance from an AI background, and often people go, well, I've done so well in AI, you know, but why not move into finance? And then what we see all the time is those people that have been AI gurus everywhere else fail quite miserably in the finance field, and there's a few reasons for it. Now, I talked a lot about this on Monday, but perhaps what I will do is bring this up again today and explain to you a little bit the challenges of this sort of technology. So what I'm also going to do today is I talk a little bit about the work that I've been doing on reinforcement learning in the trading field, and how this how you can actually see it, how can you approach it, how would you think about using some reinforcement learning in finance, and what are the challenges? So this talk actually was designed for people from finance. Now, what I'm not going to do today is go too deep into the reinforcement learning side of things, because for a lot of you it'll probably be fairly obvious, and you have probably done quite a bit of it. So what I will do is actually skip the first few slides, please forgive me for that, and then I just get started a little bit later on. A lot of this, the first few slides, is just about general ideas in reinforcement learning, and I suppose, or I assume, that quite a few of you will actually have quite a good background in that. So here, just talk about a little bit what reinforcement learning is. Let me just very briefly go through it. It's a so-called Markov decision process. We have actions, we have states. So states could be something like, what does the screen look like in a computer game? The action is, if you have a cursor, move left, move right, up or down. What is a reward is basically get some points, get the score. And then we have policies. This is bad. It's not good. All right, is this better? Yeah. Yeah, I wasn't sure, because on stage you don't hear it very well. Okay. So basically, you've got these rewards, and then we end up with something called a value. So in practical terms, we start from A and we want to go, let's say, to F, and for every step we get like a reward. There could be a positive or a negative reward. So here we get, let's say, 20 points. Here we get 1 point. And the interesting thing is this, and this is true especially for trading. When you start out, you know, you could just go for like the highest score, but it does not mean that's actually the best way to go. So for example, if you start with 15 here, you know, we've got 30 here, but then we go 10, and then we get minus 100, we actually end up quite negative. But we could start with 15, and then we get 300, which is pretty high, and then 1. And so, in finance, you often have exactly that sort of decision-making process, where you actually start with something that doesn't necessarily look overly attractive to begin with, but then turns into something way more profitable. So you might say, well, actually, and a lot of you will have heard of this in finance, you know, I think it was Baron Rothschild said, oh, you should really buy when the blood is in the street. When, you know, often when you buy, when things look really dire and you have a crisis or something, and everyone else is in panic, this is when you should buy up. Which is, for most people, counterintuitive. They always buy when the markets are up and up and up. Just look at the recent Bitcoin bubble, you know. A lot of people just bought in when it was really pretty much close to collapse. And this is very similar to this, because here we start out maybe here minus 20 or whatever with something that doesn't look particularly attractive, this would only be the third rank of all the possibilities on A. But then actually we can go a path where we can really be extremely profitable. And approaching this is not easy, and especially when you try to train machines to do it. So the reason why we even train machines is not necessarily because it's fun and it's cool and it's funky. The reason is we have traditionally had traders, and you've seen all the movies on the pig traders on the floor, and those guys, they're individuals just doing it. What's nice about these machines is they're scalable. They're generally pretty dumb. They don't do very well. What they do well is they're always more or less awake, and they don't make too many really dumb mistakes. They're not exactly smart, but they really can be helpful. And most importantly, they're very scalable. This is really why we like the machines in finance. Not because they're anything else, but really scalable. You can just use the same machine for many different things. So I thought my clicker would work, but then it's actually not. So I just go back to the good old manual thing. So I skip a few of these slides and I go to this one. So talking about reinforcement learning, when I started and I saw the first approaches, when AlphaGo came out and it beat the Korean Go Master, it was pretty impressive. And I thought, well, why not see if we can use it in finance? And when I looked at it, there's so many ways you can actually play it, or there's so many ways you can use it, but the most obvious seems to be to gamify finance, meaning that when you apply it, you could just say, well, every trade that you do is like a game of some sort, like a video game or so. So you buy, you enter a position, you buy a stock or something, and you hold it for a little while, a time goes past, and then when you see fit, you exit the position, hopefully with a profit. And games are very similar, like you have, I don't know, I don't play too many computer games, I admit, but you have something is happening on the screen, you take some actions, and then finally the game finishes and you get a score, which would be your profit and loss. So the problem is, how do you play this? Do you see every game as being independent, or do you actually train the machine first on a lot of games and then let it run and release it into the market? My approach was really, well, if we want to have autonomous systems that are completely self-sufficient, we need to have the machine do its thing. We can't tell the machine by training it, do this or do that. The machine just needs to run. It needs to keep going. One of the biggest challenges in this case is actually this thing called reward function engineering. And I talk about this a little bit later. In finance, when people start out, they think, well, it's obvious. At the end of the day, how much money you make is what you get. It seems like the most obvious thing, but trust me, it's really not. It's how much money you make in relation to how little risk you took. What matters? Because if you flip a coin and you gamble all your life savings on a coin and you have 10 wins, that's fantastic, but the risk is just so phenomenal that most of the time you probably not make it. And in finance, we're actually less concerned at the end how much money we make. The main importance is how little risk we actually have whilst we're doing this. So when we design reward functions, we have to take the idea of risk into account as well. And as you probably know, when we move from 1 dimension to 2 dimensions and to 3 dimensions or whatever, suddenly problems become a lot more complex. And so engineering a good reward function for finance is anything but trivial. And I'll talk about this a little bit later. Just wanted to introduce this. Then the next thing is, well, we use neural networks for reinforcement learning. That's the sort of basis. There's other things we can use as well. I talk about this a lot in other talks, but what I found is unlike in other fields, in finance it's actually sometimes really, really important to stay as simple as possible. It sounds counterintuitive, but finance is a very complex problem for two reasons. One is financial time series are extremely noisy. So if you're in AI and you do image recognition, imagine you try to recognize an image which only consists of 5 pixels. It's just like basically noise. It's not that easy, right? And the other thing is, imagine when you try to recognize the pixel, by the very act of doing it, the actual image changes or what underlies it. Because when you deploy algos in the market, they change the market. They change the market according to the rules of the algo, but then the market feeds back into the algo as well. So it's quite a complex feedback loop, and we call it, nonlinear dynamics. And who knows another word for nonlinear dynamics? Chaos. so it's pretty chaotic out there. Then another question is, how do we test those systems? It's not trivial, because when you run reinforcement learning, if you train a reinforcement learner on computer games, it's fairly straightforward, because you can play as many games as you like. But in finance, you have only a limited amount of historical data. It seems like there's a lot of it, but in reality, there's not. Markets are fairly limited, and the data are fairly limited. So, when you think you train it on daily data, there's only 252 trading days in a year. It's a really small set. So, if you have 1 million data points, you cover pretty much the whole market for years, for many, many, many years. And a few million data points in machine learning are a joke. It's not very much. So it's actually quite difficult to train and test the systems. And if you have a few million data points and you try to split them in a train and a test set or something, that's already, again, it's difficult. And then, of course, what type of neural network should we use? There's a lot of choice, recurrent neural networks and LSTMs. And to be honest, I'm not an expert in all the intricacies of those neural networks. I'm what you would call a user of them as well. I know a little bit what they do, but so this is interesting. It's just stopped responding to my.
Hey, I'm Ruturaj. I'm just learning deep learning. Started with machine learning and moved on to deep learning. So my question is very specific. Based on the reward function engineering that you talked about, and the $1 million of investment that you talked about against the ANN, which has to be implemented.
Yeah.
The critical challenge there is to keep on improvising data sets, right? Because as you rightly said, the amount of data which is being gathered is ever changing.
That's right. Yep.
Yeah, and at the same time, my question is, does deep learning, machine learning, or any algorithm or any financial formula gives me an input that this is the time to pivot? So I'm not going.
This is the time to what?
Pivot. I need to move out of. So whatever I'm doing is absolutely wrong. The machine learning output.
Yes, of course you can do this. There's many ways to do this. This is often quite a philosophical approach. It's never really clear when the best time is to get out. And on Monday I showed an example which actually wasn't at all manufactured. I just did a little bit of. I just showed people like how to use a simple strategy, and it so happened that when you run the strategy, you can see that at first, you get into your position, and then the position keeps losing and losing and losing massively, but then it comes back almost to the point where the machine wants to exit it, but just short of it, it starts losing again even more. It just goes down and down and down. And I told people, well, this is an algorithm, but if you trade that algorithm, if you just look at the screen, this is when you really start to get your stomach ulcers nourished. And then, eventually, when you get to the point that you really get scared, and you really exit because you're too scared, it comes back and makes a big win. Right? This is how this works. And so when's the right time to exit? It's really, you can't really say that. It very much depends on a lot of factors, but there is no rules in the market as such. there is only probabilities, and you can say, well, if I trust my algo, I have a high probability for this to make money, and then you go with it. But there's no guarantee. So it's not easy to come up with these things. Here we are, great. So basically the idea is to just treat it like a game. And in fact, in some ways, trading is a game. I mean, it sounds really serious when you hear all these finance people talk, but yeah, to be honest, a lot of them are just, boys with toys. They like what they're doing. Some of them may be more gamblers, some of them may be more risk conscious, but ultimately, as so many things in life, it's a game. And so, computer games, in a way, have state, cursor movement, and reward. I use this example here because this was the first computer game, and pretty much the last computer game I've ever played, called Pong. And I loved it very much. It was like in 1983, I think. So what we're doing here is very similar. This is very equivalent. We have historical prices that we train our machine on, which is basically just playing games to train the machine. And then we have this buy, sell, do nothing, which is effectively, do you move the cursor up, do you move it down, or do you just leave it there? So this is pretty much the same. And then we have a reward, which is, in our case, our profit or loss function. So as I said to you, there's more to it. You got to take risk into consideration and so on. But in a nutshell, when you start out, this is what you would look at. Okay, let's see if this goes. No? No. Oh, there we go. Hit and miss, right? It's just like in the markets. You never know what happens. Okay. How do we train the system? I already talked about this. You can treat entry and exit as an individual game. There's other approaches. People actually, they use reinforcement learning and they apply the same learner over and over again to the same historical series, and then the machine just keeps learning different strategies and so on. And machines are actually surprisingly good in tricking you. So when you actually train them like that, what happens is that they sometimes find like ways to trick you into things. So for example, I don't know if you know, but the US stock market for the last 10 years has just been going up and up and up and up. So if you train a machine to basically optimize the profit that you can make, all it will do, it will just enter a game and then stay in there all the way to the end. It's just never gonna come out because it's like, yeah, I'm making money, it's great, well, why would I? But often this is not really what you want, because if this happens, we call it like, your risk is actually quite high, and what we want is games that play more fast, and the reason for that is instead of just taking advantage of the big upward move, when we see this big move up, we actually want to take advantage of these tiny little ripples that occur, these little up and down ripples, and if you add them all up, you can actually just triple the amount of money you can make that you could when you just go with the upward move. But of course your reinforcement machine doesn't care about this. It just says, oh, we maximize our P&L, and if we find something good, we get stuck in a local minimum, we get stuck in a strategy, and this is what we exploit and just let all the rest be as it may. It's good enough for us. So it's quite difficult to get this. So when we make the whole price series one single game, it's gonna be, so meaning to train this on the whole price series is gonna be difficult. So the other thing is when we use reinforcement learning, or when we are in finance, usually we have instruments, we have equities, hundreds of equities, or let's say the Nifty 50 in India, S&P 500 in the US. The question is, do we treat them all separately, or do we actually feed one machine, one learner into them all? And the most obvious choice to start with, obviously, is to treat them all separately. But ultimately, because they have certain similarities and certain correlations that are going on, it would be interesting to treat them all at the same time, because sometimes you've got these causalities happening in the time series where something is leading and something is lagging, and hopefully reinforcement learning would capture those. All right, same thing again. 3 times lucky? No, not at all. Okay, probably in 2 seconds it just jumps 4 slides. Let's see if I can do this by hand. Oh, here we go. Okay, so the reward function design, I talked about this. We could say, well, we get profit or loss, but then otherwise we just go 0, or we get profit or loss from the start of the trade, and then we assign some sort of profit to every time step, and basically rewarding our learner even intermittently, which is really not necessarily a good idea because we just don't know what's going to happen. We could also calculate how much profit does it make per tick every time step, because if on average we make a bit of profit every time step, this is way preferable than if we had like one time step making all the profits and then there's nothing on either side, simply because when you make a large profit at once, it's much more risky than if you actually make small gains all the way along. Then I talked about this holding, say, one equity for a long time. It's not always what we like. It's not preferable. Obviously, there's investors out there. You might have heard of Warren Buffett. They hold their equities for 30 years. Yes, of course, that is something, but that is very different from what we do in quantitative finance. We generally try to actually shorten the periods that we hold, so we can be more dynamic and more reactive in the market, rather than watching the paint dry or whatever you want to call it. It's just also a way of reducing the risk that you take by just reacting to things very fast. So what are alternatives to this P&L curve? So one is, for example, rather than looking at how much profit it makes, we could just say, well, if it gets the direction right, then that's something. We could just say, well, all right, you get rewarded for catching the general direction. We don't, and then if you can do this, okay, we reward you, machine. Otherwise, you get punished. And the other thing that is also interesting is this idea of a regime. In trading, there are several regimes that we talk about where you can make money, and they're all to do with so-called autocorrelations in the time series. So there's something called mean reversion, and there's something called momentum. It basically means you have positive or negative autocorrelation in the time series. There's a third one, it's called a random walk. You might have heard of it. It's basically just random numbers. And if you have a pure random walk, you cannot actually make money consistently with that. So anyone who ever tried to build trading strategies that apply to random walks, they're generally not possible to make money with. And this is why we actually use them to test our strategies. So if you build a new strategy and you run randomized price series through it, and it still makes money consistently, then your code is just simply wrong. And this is one of the best tests that you can do to check if your code is actually working. All right. So what features do we use? Because just pure prices isn't really necessarily enough. There's quite a lot of interesting things in those financial time series that we could exploit. And one is this idea of open, high, low, close volume. And probably a lot of you will have seen those, they call them candlesticks. There's these bars basically to tell you when did we open in this particular hour or so, or minute, and what price did we open with, what price did we close with, what was our highest, what was our lowest. And people that are good in trading and watching the markets, they actually recognize patterns in those. So you see here, there's like this flat pattern, and then you've got these big breakouts here. You see this, we would call this gapping. So there's all these patterns going on, and these patterns tell you something about what's going on in the market. Unfortunately, they're not like fully reliable. Like nothing is in finance. Nothing is actually really reliable. It was interesting because I had a few really academic guys in Wall Street in April, and the one guy said like, yeah, but you gotta have this really high confidence in what you do. And I said, well, you can't really get this. If you get 55% confidence, that's good enough. I said, yeah, but why are you doing this? This is rubbish. And he was just really insistent that what we were doing just doesn't make any sense. But it does to some extent, because people still make money from this. So there's something called technical indicators. Some of you might have heard of it. It's things like moving averages. There is also oscillators. There's all these different lines that you can use that give you some idea of what happens. For example, you can see there's these two lines here. It's not very clear, but they're most likely two moving averages, and you could say when one is above the other, then we have more of a downward trend in our prices. And if this reverses, like here, we have more of an upward trend. And so, again, these things used to be a lot more reliable in the days before algorithms came to the market, but now there's more and more algorithms, and we say the markets become more efficient, meaning that all those little opportunities that used to be there, they just become so exploited that effectively they vanish. The more you have machines trying to exploit those things, they just seem to magically disappear. And we call this alpha decay. Question? Maybe grab the microphone, please.
So, particularly from the technical indicator perspective, so have you really used this into the reinforcement learning or machine learning? My question is because this is ultimately a derivative of the price and volume, all the technical indicators.
Yes.
So, have you really used this as a feature for the machine learning or deep learning?
Yeah, it's really, you use it in the same way that as you use prices. You just feed them into a neural network as values, as feature sets, and use it. Now, when I run my workshops, I always drill into people. And this is basically being an ex-physicist. I made that mistake for a long time. You cannot beat the market purely simply with mathematics. And maybe there's some exceptions to the rule, but maybe they were also lucky. You need to have, I'll come to you in a second, you need to have some sort of economic reasoning why you do something and why that should work. So pure mathematics is great to have, but it's more of a tool to underpin your economic assumptions about the markets, your hypothesis, so to speak. So these indicators have some use generally, but on them on their own, they're actually not really a great way anymore to do something with the markets. There was a question back there. Could you maybe grab the microphone, please? Just 1 second. So, a lot of people, when they start out with these technical indicators, but the more you understand about the market, the more you move away from it.
Sorry, my question was a little to do with intuition, in the fact that the reason you're modeling financial data is because you feel that there is a pattern that repeats itself, correct? That you could, in theory, make money because there's a pattern that repeats itself. So, has there been research done in the fact that, yes, indeed, that the markets do repeat themselves? Because in a way, it's sort of deja vu, right? You're looking at things that have happened already, and do we know for a fact that the market does indeed do that?
Mm-hmm. Yeah, that's a very good question. I mean, the interesting thing is, can you see this, by the way?
Yeah.
So if you look at this, for example, right, this is like an upward pattern, right? And what you see is there is some sort of repeating pattern, because the fact that it goes upward means that, you have prices, or we talk about returns, price differences being positive. And the pattern is effectively a repeated high probability of positive upward moves, okay? Now, the thing is, until you actually realize, oh yeah, there's a repeated pattern here, you're already here, halfway up. And then you go up and maybe you are able to sort of recognize the pattern and follow it, but then before you realize, because not every one of those is up, you know, there's quite a few ones that go down as well, but before you realize, hey, it's actually going back down again, it's already quite late. So if you're lucky, you can maybe catch that trend from here, perhaps to here. So that's it. And so a lot of the time, you can see there's patterns in the market. Unfortunately, a lot of the time you only can really see them clearly in hindsight. And it looks really obvious when you look afterwards, hey, it's been going up and up and up. But when you're here, you have no idea whether it's going to keep going down or it's going to go up again. And so what happens is basically you identify patterns, and then you have a slim probability, as we call it an edge, a certain edge of them actually being correct. And it's what you exploit is that little edge. And so what you do, you know, if you and I use this example a lot, if you have a coin that is biased like 51% heads, 49% tails, would you bet all your life savings on one coin toss? Of course not, right? But would you, if you put on too little, then nothing's ever gonna happen, right? You do 1 million coin tosses and nothing's gonna change, right? It's always like you win, you lose, you know, rupee win, rupee loss, whatever. So the truth is somewhere in the middle, and you need to, as you do this, you need to understand what's the probability of you having a correct prediction or not. And based on that probability, you invest a certain amount of money in a specific trade. Does that make sense? So generally, those probabilities aren't actually that high. So there's a lot of losses generally, and even more so in machine trading. When humans trade, they usually have a higher accuracy, but also less consistency, less frequency, and so machines. The sort of win-loss ratio is actually a lot lower than for humans, but it's consistent and it keeps cracking on. And then what happens is the law of large numbers kicks in, and so over time you get a compounded effect of that, which will then actually lead to some bigger wins. But you need quite a bit of patience for it. There's one more question here. Two more questions. So just wait a second for the microphone.
Hi, Tom. So we know the trading is all about demand and supply, right?
So yes.
So along with the prices, if we incorporate the volume that was traded, won't that be helpful? That how it is going on?
Okay, so would we incorporate the volume in? So first of all, in the markets, it's not just all about supply and demand. It's also about people being mad or machines going wild. So you know, and a lot of times actually, and we've seen this more and more in recent years, supply and demand isn't really a big thing anymore, and so volumes actually are not really indicative of what happens, you know. And this is particularly true for Bitcoin, for example. When we saw Bitcoin happening, the volumes didn't have much meaning. You know, you can actually drive prices up with very little volume, and so you could drive prices up with a lot of volume, but what does that tell us? Actually not a lot. And so whilst volume does have a definite place here, it's not always a very good indicator for what's happening. Of course, you know, a lot of these topics I could talk about for a whole day in itself, but that's, and of course they also reflect my personal opinion, so other people might have very different opinions. I just want to say this.
Yeah. You talked about technical indicators as daily moving averages and oscillators.
Yes.
Within moving averages, do you prefer to have a time slicing of 100 DMA, 200 DMA, 300 DMA? That is first question. And second question is, apart from these two, do you consider VIX and GDP, changes in the GDP, as the official tech indicators?
Okay, so for those of you who are not from a finance background, it's basically about what would you consider to find basically predictors for price changes. So we basically say, well, how can we tell with some confidence whether the price goes up and down? And we consider things like as I said here, those moving averages and the difference between them. But there's also this thing called the VIX. It's like a volatility index, and it's also called the fear and greed index. So basically telling you, oh, how fearful or how greedy is the market, and would we consider those? Yes, we would, 100%. The most important thing here to remember is all of these, more and more so in recent years, have had smaller influence or smaller predictive value in the market. It's still there, but it's getting thinner. And so what you need to do is you need to find sophisticated ways of combining all those different influences and basically figuring out a compound way to make better predictions. And so the easy way would to take them, normalize them and add them up. Or then what we do is, of course, and this is when we come back to machine learning, we find more nonlinear ways of combining them, which is effectively, nonlinear regression, also called neural networks, support vector machines, and all these sort of things. So, yes, these are still important, but there are less and less so as individual indicators. So there's a lot more now that we need to build in compound. And this, in a way, is also when we have stuff informing those reinforcement learners, we need to be aware of that as well. All right, next clicking action. Yeah, I see reinforcement learning. Not sure what I did, but I did something. All right, so how can we test the system? So the way, when you start with this, what you don't want to do is take price series and feed the machine time series, because there's absolutely no way to know whether your machine's actually doing the right thing. So what you normally do is you use sine waves, then like some upward trending curves, stuff that you know has some sort of known properties before you even touch any sort of trading or any financial price series. I talked to you about random walks. It's my favorite because you can really, and this happens a lot, you can see, I make money consistently, okay, I've got a bug in my code, 100%. Or maybe not even a bug in the code, but what often happens is it's really easy to get your conceptual thinking wrong of something, and especially in finance, it's really easy to somehow get the conceptual thinking wrong, fooling you into like, you see those enormous profits and you think, oh my god, this is just absolutely fantastic. But every single time I found something is too good to be true, it always was too good to be true. This rule never actually failed me. So then I talked about autocorrelation a little bit, meaning that today's price change is somehow correlated to yesterday's price change or some sort of price change in the past. And this is generally, when we make money, we make it through autocorrelation, and the other thing is causality. So causality meaning something else causes this to happen, and that could be in Australia, if it's a beautiful day, right, and the sun shines and you have a manufacturing company, then generally everyone just leaves work at 3 p.m. and goes to the beach, so your productivity goes down. So if you have a lot of sunny days, probably the price of your stock might generally suffer a little bit. So, or another one, this has actually been used in real trading. A guy looked at the golf scores in the US. People have to publish their golf handicaps. And what you can also see along with this is the CEOs and how much time a CEO spends on the golf course per week. And they found a really strong negative correlation between how much time CEOs spend on the golf course and how badly the company is doing, or how well the company is doing. So if they spend a lot of time on the golf course, generally their company is really suffering. And the guy actually traded this. And so, we always think about technical things, but these are actually, in my opinion, things that are really, really interesting. And trading, to that extent, is what I love. You got to be really inventive and creative and come up with these ideas. Another one, you might have heard, someone took satellite images of how many cars are in the car parks of department stores, and they actually predicted the demise of JCPenney, a big department store, because they saw there was less and less cars in the car parks over time. and the stock price as well went downhill, and eventually they went bankrupt. And so that was just done purely by machine learning and satellite imaging, so just identifying the number of cars in all these department stores in the US. There's quite a few thousand, I think, so it wasn't easy to do. Then we built some of these sine waves and trend curves, we adding noise to them. So before we even do all of this other stuff, testing prices, we just take those clean waves and we add noise to these clean waves. And then we talked about this as well. We could probably add some reoccurring patterns into those. So, but probably what we would do is, just create some of those specific candlestick patterns, and then we make them randomly appear, and then see if the machine actually picks it up. Unfortunately, one of the issues is that the signal to noise ratio is so bad in those time series that, unfortunately, a lot of times those neural networks really learn noise rather than the actual underlying principles. Probably some of you have seen those Google Dream images, where basically there was neural networks image recognition applied to white noise, and just the machine learning systems build these beautiful pagodas and dream animals and all of this, but actually it was white noise. And this is often what happens to traders as well. You see like beautiful time series, you think there's money in there, but it's actually just noise. It happens to the best of us. Oh, here we go. It's getting better. Okay. What is that? I have to go a bit closer, right? Yeah. Oh, that's really... See, when you're on stage, you're just so nervous. Sometimes you miss those things, but then that's again. You see, this is a clear case of causality. Something from the outside informs me about a fact, and then I can exploit that fact, which isn't actually part of my immediate reality. So you had a price curve, but you couldn't necessarily see in that price curve what you get. But then something from the outside will actually have an impact on this, and then you can exploit that, which I'm gonna do from now on. All right. So what type of deep learning algorithms? You probably know all this. This is just standard stuff. Neural networks, convolutional neural networks. By the way, some people did some interesting work in finance with CNNs. There's also SVMs, and decision trees are actually really hugely successful in finance, much more so than deep learning. So XGBoost is one of those, and actually support vector machines do extremely well. And for the last 2 years, I have been trying to find out why SVMs would be so good compared to deep learning, and I still haven't figured it out. If anyone has any idea, I'd be really interested. You might have an idea?
Yeah, SVMs tend...
One second, grab the microphone, because I really need to hear this.
SVMs tend not to overfit.
They what?
They tend not to overfit.
They tend not to overfit?
Yes.
All right, that's interesting.
So if you have...
Okay, carry on, sorry. I didn't
there's been so many examples of where a neural network will fit very correctly to a data set, and you'll almost have no training error.
Yeah.
But in fact, you actually overfit the algorithm, and therefore you're going to make really bad decisions when you're testing an out-of-sample set.
Mm-hmm.
Whereas if you have a support vector machine, you tend to not overfit. So if you define a fixed number of support vectors, so overfitting in a support vector machine is more obvious, because if all your data points are support vectors, then you have clearly overfit your model.
That is really interesting. Thank you for that. In fact, sorry?
There is almost.
What is? Oh yeah. Hold it for a second. I just wanted to say, just as a response, when you what they found is in the Quantopian that training and finance platform. What they found is that overfitting, in fact, is the single biggest problem for traders. So any sort of automated finance is hugely prone to overfitting. Even just looking at, it's not even, you don't even start doing anything. You just look at something and you're already overfitting. It's that bad in finance. So I can totally see that issue, which is which is very interesting.
If you look at just the size of the neural network, right? If you have, say, n number of input features you're using, you tend to usually need about n square, n cube
Yes.
training examples. And if you're dealing with whatever 225 days of training for a year, you definitely don't have enough data. You
Yeah.
use deep learning. So.
Exactly. It totally makes sense. There was something. Someone you said something.
Yeah.
Maybe just or just grab that microphone.
Go to the maths, the real crux of SVM, and try to understand the maths of the SVM. It says that, in comparison with the neural network, maths behind the neural network, the neural network can easily fall into a local minima.
Yeah, in fact, I'm talking
Whereas
about this.
if you go to the maths of SVM, it's never end up in the local minima.
Yes.
That's the biggest
Yep.
advantage of
Yep.
SVM over neural network.
That's a really good point. And in fact, that's also very interesting because when you start training these, I said there's a few regimes in trading. One is mean reversion, another one is momentum with different types of autocorrelation. And what you see is that a reinforcement learner or neural network starts learning very well a regime, but as soon as the regime changes, it really struggles to come out of that local minimum. And this is when we come to this exploration versus exploitation paradigm. When we start seeing some regime in the market, we want to exploit it, and we want to really ride that wave. And so for a while, it's doing really well, but then when the regime changes, we need to come back into this exploration mode. And if we don't pick this up fast enough, we will actually see our reinforcement learner or neural network getting extremely confused and not knowing what to do. And what's also interesting is, and a lot of my colleagues in finance that use a lot of machine learning will say the same thing. Unlike in any other field of machine learning, pretty much, in finance, it's mostly better to train your machines on less data than on more, because what happens is in most applications, these local minima converge into specific types of trading, or specific ways of trading, I should say. And so machine learning applications, whatever it is, really just get confused when you train them on too much data. So they do produce some profit, but it's nearly anywhere good enough. And so what a lot of practitioners find is you have to basically run them on less training data and retrain them a lot more frequently. And this is, at the moment at least, the best we can do. What we haven't, or at least as far as I know, we haven't really found yet any of those deep learning applications that can actually learn various trading strategies and learn to switch between regimes as well. It seems to be a really, really difficult problem to solve. All right, I'm stepping nearer, and bam, very good. So, I just I've actually got I got a little demo thing up here on GitHub. So if anyone wants to download this, it's a pretty simple code, and I try to make this as simple as I can, just to demonstrate the use of reinforcement learning. And in one of my workshops, someone came to me and said, "Tom, I really don't. It's too complicated. I'm really not sure." I tried to add a few more comments into it. It's just really, really hard to make this stuff as simple. I usually pride myself in making things really understandable for people and simple, but in this case it can be a bit challenging. But it's not too long. I'll show you the code later. So this is just some results. If we just use a sine wave and then or a trend, and we really add no noise whatsoever, we can actually see after an initial learning phase, our reinforcement learner does extremely well. So what we hear is basically what we have is initially starts with a sine wave, and then it turns into a trend. So it actually does change regime from mean reversion to trend, But if there's no noise, our reinforcement learners pick that up very beautifully. And then next, we have basically this is a sine wave with quite a bit of noise in it, but still quite recognizable as a sine wave. And you can see at first it's really not doing well for quite a while, and then bit by bit it's actually improving. And this is still up here is still very acceptable P&L curve. But again, don't forget, this is actually still extremely, it's still got a lot of signal compared to the noise in here. So it's still not too challenging as a time series. So this is another thing, it's like a trending series with some noise. And then it's already getting a bit more difficult. But you can still see there's something happening here. There's definitely a distinct uptrend. So all of these things are basically just there to test and to see whether we can do something. And then we come to the actual reinforcement learning of time series, and we can see that we have those moments where it's actually going quite well. You see these are quite, in terms of time, they're actually quite long time frames. They're several years. But then the regime actually changes, and then we see that it's just flat. Or in this case, it's interesting, it actually reversed. You could see there's a definite consistency, but in the other direction. So you can see that the reinforcement learner, there's a really high probability it picked something up, but it picked it up previously, converged into a local minimum for this particular case. But what actually happens in the market now is exactly the opposite. So it makes decisions, and if you only reverse the decision, it's actually doing really well. So this is just a clear case of a local minimum, just exactly out of sync with the market by 180 degrees, so to speak. And I think this is really interesting. The more you do this, the more you see examples of this all the time. So what can we learn from this? One of the biggest things is that reinforcement learning is just really simple and efficient. You know, when people started training those simple Atari games, they needed 70 million frames to play, and we're talking about frames. So it's 70 million games really that you had to play in order to be successful. And this is just fully out of question for financial time series. It's just not enough data to train it on. Then I said this reward function design is hard. The problem is also rewards in trading are sparse. So when you run trading games, you only enter and exit every so often. There's not that many rewards, and because you have so few games to play, a lot less games than you actually have data, it gets even more difficult for the reinforcement learner to make sense out of what it sees. We talked about this already, local optima. In fact, this was designed for talk in the US, and interestingly in the US there's very few people ask questions intermittently. So this time I already talked a lot about these things that I wanted to say with your questions, which I think is really fantastic. So escaping local minima or local optima is probably the next thing that really needs to be tackled, and we're already working on that. Then reinforcement learner just overfit on particular chart patterns. This is something that's really obvious. You see sometimes chart patterns occurring over and over again for some time, and the reinforcement learner finds it extremely easy to adapt to that, and then once it's changing, it never actually comes out of this particular pattern, and then just keeps making losses after losses. So the last thing that is quite tricky is a lot of the results can be quite unstable. So when you train it on actual market data, you will see that it's quite hard to reproduce and to actually redo it. So my next slide. So I already talked about this quite a bit. Perhaps one of the things that is actually important is computing power is still limited. I mean, you know, we seem like we have really unlimited computing power now, but we find that is still actually a bit of a challenge. It's not that straightforward, and what we're dealing with a lot of finance companies here that are not necessarily resourced infinitely. So to really build scalable systems for them that can really deal with the more and more increasing need for computing power isn't actually that trivial. Like, it's trivial in an academic sense, but in a practical sense, it's actually quite challenging. I believe there is still a lot of algorithms yet to be discovered, and some of them will be probably the one that we want. What are some of the solutions? So this is obviously something that I'm most interested in. Where can we go with this? Because there's just so many ways to go, and somehow we need to figure out what's best. And so some of these, I'm not sure is this the right word, but there's these geometrical solutions. We find that markets are inherently fractal. There's quite a lot of fractal dimensionality in the markets. This can definitely be exploited. This is a little bit away from machine learning, but actually I think that more and more we're starting to understand now how we can combine the idea of fractal dimensions with machine learning. The other thing that is really interesting is evolutionary systems. So what we do is we use really, really simple learners, like lots and lots and lots of simple learners, thousands of them, and we deploy them, and then we just put an evolutionary algorithm on top, and we basically produce natural selection. We just look at how all these algorithms perform, and then we just generate a swarm of those or a group, and then we can either switch them on or switch them off. We can generate new ones, we can kill the ones that have not been useful for a long time, and so on. So this seems to be a really, really interesting approach, but again, it's quite challenging from a computational point, because building those on say cloud computing clusters and then supplying them with the data, getting all the data out of them, all this in real time. You know, you have to do this completely in real time. It's actually really challenging just from a pure IT standpoint. And yes, there are solutions to that, and yes, they are possible, but to actually building them, making them robust is not trivial still. Swarm intelligence has been suggested, and a colleague of mine works on that. Seems like an interesting thing, and I would learn a lot more about it, but I'm not that good at it. Better algorithms, absolutely. And when I say better, I say not more complex. Because in finance, actually, it seems like the simplest ones are always the best. And it's really interesting, especially when you use deep learning. Even just hyperparameter optimization is already almost a complete no-no in terms of overfitting. You just add a layer and you're already overfitting. It's just something that we really need to address, and as I said, simple SVMs still seem to be the thing at the moment, and we'll work on that. And finally, me being an ex-physicist, quantum computers, I've actually got my claim to fame is I co-organized the world's first quantum computing hackathon. It's called the Quackathon. I really believe that quantum computers will definitely play a big role in the very near future, and there's already a bunch of investment banks and so on working on using quantum computers in financial applications. It's still really, really early days. It's like computing in the 50s, but I found it really fascinating. I mean, I organized this quackathon, but I participated as well. And actually, I don't know if any of you ever touched quantum computing code, but it's such a different way of thinking. And I think, you know, we will really, in the future, when people start writing code for quantum computers, you really need to step away from your traditional sort of if-then thinking in programming and really look at, you know, entanglement and superposition of zeros and ones. It's pretty fascinating, but also extremely challenging and a lot of fun. So, stepping closer. Almost. One more. Sorry? Swarm intelligence. It's basically when you okay, sort of. Just give me 1 sec. Seems like okay. So swarm intelligence is basically when you have, like, let's say a swarm of birds in the sky and they fly. Somehow each of them knows exactly where their place is and how they can act as an ensemble without actually really knowing what they're supposed to. There's no clear instructions for any of them what they're supposed to do, but yet there is this inherent connection between them through really simple things, like they just feel the air on their wings or something simple. And because of those really simple interactions that occur, they have a really superior intelligence as a group, as a swarm, and can move in a certain way. And as the birds are on their own, they might actually be a lot more chaotic. So you could see that when you have a group of learners that are just really loosely connected, but in a very intelligent, specific way, and they act as a team, so to speak, they can actually form these really, really superior systems. And again, I'm far from an expert in this. This is just something a colleague of mine researches at the moment. Whether this will ever come to something, I don't know, but it's fascinating. Finally, I just want to show you this, and I think this is quite powerful as well. What I've done here is I just took the financial series and applied just a small smoothing filter, a simple moving average, and this is actually 5 periods. So what that means is you see this blue line here, which is the actual price curve, and then the moving average, 5 periods, just smooths that price curve a bit. And this is really zoomed in very, very deeply. And if you actually saw that yellow line on this, you wouldn't even be able to distinguish it from that blue line. But what we can see here is, if we just take out a tiny little bit of noise out of the time series, we actually suddenly get some really, really amazing performance. This is really good. Again, initially, it's not sure, it's just learns. This is actually the space of probably about 3 years. And then once it's actually understood that, it's starting to really pick up and does an amazing job further on. And I think it's very, this sends a really clear message. We need to somehow deal with the noise in a better way than we have been so far. This is probably, in my opinion, the biggest challenge for machine learning in that space, is how do we deal with the noise more effectively. Unfortunately, it would be nice if we could just say, oh, we just apply a moving average and just trade on that. It's not that simple. But it's definitely a step, an interesting step in a direction that we need to look at. So if anyone understands a bit more about noise filtering and how you can do this in various ways, there's definitely a huge potential here for building some interesting applications. So there's a few other things. I don't know if anyone heard of this. There's this idea called reservoir computing. This is actually really fascinating. People, if you take chaotic systems, or systems that have a non-linear dynamic in them, they're incredibly difficult to predict. You know, it's that butterfly effect. You know, one wing flap has like huge ramifications on the other side of the world. So people have now actually been able, using this reservoir computing, to get a really phenomenally accurate prediction of really strongly nonlinear systems very much in the future. So in finance, it's not quite the case yet, but I think there is definitely some interesting applications there. And I already mentioned quantum computing. These things get better and better, actually. It's quite fascinating. We have now quantum computers on silicon chips, and I think they're now getting into room temperature quantum computing and all these things. Short of time, so we can take one more question. And I tell you what, I'm still available afterwards, so you can come to me. So one more.
So my question is, I'm just wearing a hat of critical thinker, black hat, and I'm asking this question.
Yeah.
Good. Based on what I learned for last 2 hours, you just shared your journey towards the reinforced learning, and what ifs and all of that, right?
Yeah.
My question is, at what scale of data have you tested this?
At what
for how
scale?
many years? For how many dollars?
Yes, I've. That's a good question. I've actually tested this over 1993 until now. So it's like 20-something years. Over a large amount of instruments. I mean, this is just you know, what I present here is just the tip of the iceberg. But basically, with my quant team, we're constantly looking at new papers and basically building new machine learning things. And I mean, 98% of them are not useful. Like, a lot of it is just not really actually that applicable. But we have done a lot of work and a lot of studies on that. So, you know, it keeps evolving. But yeah, I mean, you know, you could argue, well, you could do a lot more. But, you know, there's always a time and resource limitation as well. But we have done quite a lot of extensive work on that, 100%. So with this, I probably have to close. We're getting late. I'm still here for a few questions if you want to ask me personally. Thank you very much, everyone. It's an amazing audience. I'm always blown away by India. This is my last day here. I'm flying out tomorrow, and I just want to thanks to everyone, to Ideas. Thanks for providing this, and I hope I'll be back soon. So all the best and good luck with everything. Bye bye.